Hey YouTube, I'm Jimmy. In this video, I'm going to walk you through my analysis of Cisco Systems, ticker symbol CSCO. This continues our series where we're analyzing all 30 stocks in the Dow Jones Industrial Average with the ultimate goal of taking those companies and trying to build a great portfolio. This is a 7th video in that series, and you can see a link to the playlist in the description below. So I'm going to quickly touch on Cisco's business, and then we can look at a potential shift that appears to be happening in their core operations or with the direction of where their business is heading. And then we can try to decide if we think that that shift will move the stock higher from this point going forward. So Cisco breaks out their operations into 3 primary segments: infrastructure platforms, applications, and security. The infrastructure platform segment accounted for about 80% of revenue, while the other 20% was spread around applications and security. Now, at first glance, this is a bit concerning for me from a breakdown perspective, mostly because of how the infrastructure platform segment is structured. This segment mainly works around core networking technologies. Think switches, routers, and data centers. And this is how Cisco built their business back when they started in 1984. The hesitation for me, and it's not just my hesitation, many analysts are saying the same thing, is times appear to be changing. The cloud is steamrolling forward. And sure, there's always going to be a place for this segment which sells devices that, let's say a big business had it, it would be they have the servers on site as opposed to a business that utilizes the cloud and some server farm somewhere. And the question for me is, how will this business look in the next 5 years, the next 10? If you look at the past 5 or the past 10, it's changed rather dramatically, and it looks like Cisco was left a little far behind. Well, the good news is that the company seems to know this, and that's why they're pushing more towards the proper future, which is more subscription-based services versus individual contracts. And that's good from an investor standpoint because subscription-based services tend to be recurring revenue. And you can see this is true in some big acquisitions that Cisco's made in recent years, which focuses more on their applications and security segments, both segments which appear to have a much brighter future. Now this brings us to some recent acquisitions. Now one thing Cisco loves to do is make acquisitions. I counted their acquisitions, and since 2010, they've made 33 acquisitions, mostly all cash acquisitions, which, assuming that they have the cash, I like better than a company issuing more shares and diluting current investors, which for me generally seems to be a safer thing. There are exceptions to that, but generally I prefer a cash acquisition over a stock acquisition. Now these acquisitions have ranged in size from as low as 20 million to as high as 5 billion. This table here, this shows all of the acquisitions since 2010. But since Cisco has almost 50 billion in revenue, I'm not terribly concerned about the 20 million or even $100 million acquisition. I'm more interested in the big ones. So this table here, this is their largest acquisitions since 2010. This red one here at the bottom, this one actually fell into a segment that they called Other after they acquired this company back in 2012. I highlighted it red because although this is their largest acquisition recently, they're actually in the middle of selling it, which they haven't disclosed what they're selling it for, but I figure we can mark that red just so we know it's not going to be part of their core business going forward. And the fact that they're selling this particular segment is interesting to me because this goes back to the shift I mentioned earlier. So with the other acquisitions, we can see that back in 2012, they made an infrastructure platforms purchase. And since then, all the big ones have been apps and security. Now, I think this is a good thing because as we mentioned before, I believe that these 2 segments have a brighter potential than the infrastructure security segment. So for now, before we dive into the potential shift in the business, let's look quickly at their financials. So here's their revenue going back to 2010. And as you can see, they were growing fairly nicely from 2010 to 2013. But then they seem to have stalled out a bit. Now, if we switch over to profit or net income, we can see that net income has continued to grow fairly nicely thanks to improving margins. Now, as we saw from our recent CVX analysis, I think it's important to compare growth to other competitors in the same industry. So when we look at where Cisco generates their revenue, it looks like competitors would be companies like Juniper Networks or Netgear. So we can see in this chart that both Juniper and Netgear are growing. Juniper is the blue bars and Netgear is the orange line. Then if we jump over to their profit, we can see that they're a bit volatile, especially Netgear's orange line, but this is a good example of why they may not be the best comparison, because Juniper is a $10 billion company and Netgear is a $2 billion company. Meanwhile, Cisco is a $220 billion company. So now, if we account for the size, companies like IBM or Microsoft might be a better comparable. So this is revenue for IBM and Microsoft. IBM is the green bars and Microsoft is the dark line. Interestingly, IBM has struggled recently while Microsoft has done pretty well. When we switch to profit, we can see that IBM has once again continued to struggle and Microsoft has turned higher over the past few years. Now, if we jump back to the profit of Cisco, we can see that relative to peers, Cisco has done fairly decent. To make their profit story even more interesting, especially from an earnings per share perspective, is their buyback program. Here, we've added their buyback history over the past few years. Now, I'm personally a fan of buybacks because I believe it's a good way to return value to shareholders. But that's only true if the stock is not overvalued. So, was it? So what we've added next was the average forward PE during that year. Now, you may notice that we have 2018 in there, and that's because Cisco's fiscal year ends in July. So it recently ended. So each of these years, the average is actually July to July for that fiscal year. Now this is interesting, especially because when we consider that the S&P 500 is currently trading at a forward PE of about 18 times. But if we look at Cisco's history, we can see that it's had a fairly low PE. But now, what if we added their own 5-year average to each of those years? This is what we come up with. Now, as we can see, it looks like Cisco, for the first 2 years, paid less than their 5-year average. And more recently than that, it looks like that they paid a bit more than their 5-year average. Now, this brings us to the potential shift, the potential opportunity, and some recent news. Back in February of 2018, after the US tax code reform was announced, well, Cisco announced that they were going to bring back $67 billion from foreign countries into the US. Then and only then would they be allowed to do buybacks. This repatriation of that cash allowed for this $25 billion buyback back in 2018. Now, they had authorized $31 billion at the time, so there's still another $6 billion available for buybacks. Now, I would say that this partially explains management's decision to pay a higher PE than the average, since a tax change had just happened and they were sort of forced, they suddenly had the ability to issue many more buybacks thanks to the influx of cash. Now, another piece of news that recently came out during their last earnings call was the announcement of the Duo acquisition. Now, this helps push the advancement of the segment, the security segment. And I think this is key for Cisco to continue to develop. Now, another thing is that on their balance sheet, it looks like Cisco still has about $40 billion in cash. Now, for Cisco, this actually isn't that unusual. They've had this level of cash, give or take, for the past few years. Now, as far as the potential shift in the business is concerned, I think that this acquisition points to it. In fact, the past 3 acquisitions point to the fact that management has recognized that business is going in a different direction. And frankly, I've been somewhat surprised that these acquisitions haven't been larger, because don't forget, Cisco's a $220 billion company. So my question is, are they going to begin to make larger acquisitions? We know that they like to make acquisitions. What are they going to do? Are they going to continue to push towards the developing cloud business, applications business, and the security business? And recently, management has stated their push to go towards more recurring revenue streams, specifically in the security and application segments. If you pair that with the newly available cash from the repatriation after the tax changes, and I think it's possible that management starts to make bigger and bigger acquisitions in those 2 segments, which I believe will make their revenue stickier and over the long run has the potential to shift their historically low PE multiple to something that is more broadly in line with, let's say, the market or at least the industry. So for me, the potential opportunity is the combination of the fortunate timing of the newly available cash and the management's push towards a new business model. I actually hope that they don't pay out the $6 billion that they have earmarked for buybacks. I would rather that they announce an acquisition that progresses their new business direction. And I would be very excited if that acquisition was a $20 or a $40 billion acquisition. Cisco, after all, is a $220 billion company, and they need big acquisitions if they want to materially move their revenue going forward. So I believe that if Cisco continues to push down this road where they're progressing the right kinds of business, I believe their PE multiple should be higher than the current level of 16x. Even if it's just closer to the market average of 18x, that would imply that Cisco stock should be worth closer to $60 per share rather than the current market price of $48. And that's 25% higher. I personally like management's new direction. Do you agree? Do you think that Cisco looks like a good value at this level? Is the new direction of the business already priced into the stock? It could be. And is the cash really a potential opportunity, or have they already gone ahead and spent everything that would have been used? For me, the real question about Cisco is whether or not it belongs in our ideal portfolio. This one is a borderline one because I don't think we're going to be able to determine that until we get to the end of the analysis. Many people say that Cisco should be a core holding because of what they do and the uniqueness of their offerings, but I'm not 100% sure yet. We're going to have to continue our research before we can really determine whether or not this is worth that. Plus, I want to see, do they make these acquisitions? Do they continue to do it, or is it just a theory that we've come up with and they never follow through with it? If that's the case, I believe that revenue may continue to struggle to move forward, and their profit growth may be capped out because you can only improve margins so much. So let me know what you think in the comments below. And don't forget to hit the subscribe button. And if you have any questions or any ideas, let me know if you think this one belongs in the ideal portfolio. Thanks, and I'll see you in the next video.